Good morning, ladies. Good morning, ladies and gentlemen. Welcome to yet another session of the DTB Personal Financial Management Training. Karibuni sana. Karibuni sana. Can see you joining. Let us know, say hello. Yeah, welcome once more. Today is module 2. Last week we covered module 1, which was on debt management strategies. And today it is module 2 on introduction to investments and fixed income investments. So karibuni sana. I hope you are ready to learn and to engage as always. You can say hello on the chats. And as always, what you have been learning and what you have really taken away from previous sessions. So karibuni sana. We are glad to have all of you here.
Hey, Joshua.
And let us know if it's your first time or you've been part of this journey. Welcome all. Well, this is Mantui from Diamond Trust Bank. I am your host today. Yes, karibuni sana. See you all, Angela, Peter, Ivy. Thank you so much, and welcome all to the session today. I will just give everyone a few more minutes just to join in. And even as they join in, allow me to introduce our trainer today. We have, as always, Elizabeth on the chat. But other than that, we have Joe today. Allow me just to read a small introduction on Joe. So Joe Mukoko is a seasoned business development and operations expert with over 17 years of cross-sector experience spanning banking, energy, and SME support services. He is also a certified national trainer, mentor, and curriculum developer, having worked with leading institutions such as GIZ, SME Founders Association, and Christian Business Angels. Joseph holds a degree in economics and business and has undertaken executive training at Strathmore Business School, alongside global certifications in leadership, entrepreneurship, and strategic planning. I think if you are here during phase 1, you might recognize Joe. And so he has joined us yet again for today's session. So thank you so much. Apologies for the background noise, should reduce in a few. Yes, great. So I think Elizabeth, you can say hello as always, and then we can have Joe coming in. Thank you.
Thank you. Thank you so much, Mantui, and happy to be here this morning. It is always a pleasure to come share the stage, just to understand each other and see where we are going. So last week we discussed about debt management, and we saw a couple of us register on the dashboard for them to just be able to put their debt management tools. So we really appreciate that. Remember, we only change by doing. So even as we go through this, that DTB has been gracious to pay for us, let's just make sure that we are doing the work. So not only are we coming to listen, but we are also really coming to do the work. So for me, the challenge is, as we jot out and we listen out, let's just make sure that we are committed to doing the work. So thank you so much. Thank you, Joe. I'm sure you're going to take us through this, and we shall take the questions as they come. Thank you. Back to you, Joe.
Thank you very much, Elizabeth. Thank you very much, Mantui. And I am glad to be on this platform again, even as we continue this discussion on, you can imagine one of the things that we normally do is we take care of our health by eating right, going to the gym, running Stanchart Marathon or running marathons, hiking. We take care of our personal development by going to school, to add to the certifications that we have. And the purpose of these certifications is for us to be better as human beings and mentally. And as we do all these things, there is something that helps us take care of either our health by eating right. Means if you had to go on diet or if you had to go to a gym, you must be spending money on something, right? So this money needs to come from somewhere. Where will this money come from? You need to do a certification. Where will this money come from? So these are the conversations we need to have today, that as we manage our debt, then we also still get to invest, because it's important for us to grow. And I'm so happy to be here with all of you today. As I can see, we have people joining us from Watamu, people joining us from Mombasa, people joining us from Kisumu, from Nairobi, from Nakuru. Thank you so much for being in this space. Now, part of the challenge that we have is that we have to balance out life. We have to balance our daily needs, our present needs, with our future needs. Sometimes this balance could be tricky. Sometimes it could be simpler and easier for some of us. But then for all of us, there is a playbook that then we can get to follow. And part of the conversations that we have at Zurich is helping individuals take charge of their finances, understand what is coming in, understand what is going out, understand where it's going out, and how then it can get to help you. So today we'll have a brief discussion for the next hour, 45 minutes on investment, and specifically today, fixed income investment. Next week, we will look at other forms of investment and equities, alternate investments, and how we can get to take advantage of it. But today, space belongs to how do we invest? And then an introduction to fixed income investment. And then taper it off with questions, answers, and reflection questions for you and I as we grow. So feel welcome and thank you. We have a sign language interpreter with us today. I think it's Roslyn. So Roslyn, welcome. And then I'll be assisted by Mantui and Joel on the chat space to just monitor what will be going on there. Allow me to begin by us playing these 3 questions, all of us together. If you received 100,000 shillings right now, what would you do with it? And where would you invest it? Maybe we could have it on chat. Could it be in Sacco, land, crypto, shares, money market fund, business, chama, or go on holiday? Simply replace your phone and get a new phone. So if you were to receive 100,000 shillings today, where would you put the money? Maybe Mantu, you can help me read the chat space.
Yes, we have answers coming in: business, MMF, shares. Some of the organizations are listed, and then MMF, invest in Sacco, pay some debts and buy MMF, go on holiday and have some in MMF, land, business and shares, apply for a course on MMF, first settle my debts, then invest in my Sacco, holiday. So yeah, a diverse answers, but clearly MMF is a popular one.
I'm seeing MMF is a popular one. No, thank you. And then for those of us who've answered, what would influence your choice? Is it because MMF is a safe place? Is it because shares are a safe place? Why invest in that? Maybe you could also have it in chart.
So we have liquidity, higher interest, liquidity returns, safety and returns. Sacco would increase my limit, then take a loan to do business. Shares because of possible higher returns. To buy time as I decide on how to use this wisely. It's easily accessible. T-bills are safe. You can monitor my funds. Put in a fixed deposit to earn interest. Assured return, shares and dividends. Yeah, so that's some of the answers coming in. Even capital preservation. Yes.
Thank you very much, Mantui. Capital preservation. So as we think about this capital preservation, allow us to go to question 2. We want to preserve the capital that we have. So what is the one thing you've always heard about investing that you're not sure is true? 1, could it be that land never loses value? 2, could it be that only the rich can invest? And number 3, could it be that you need to time the market? So what's one thing that you've always heard that you're not sure is true of those 3? I like that one. Land never loses value. Only the rich can invest. Land never loses value. I like that. Thank you very much. And then the last question. We are trying to preserve our capital. We have invested in MMF, listed shares, holiday. We want to make sure that our money remains. So I would like you to look at where you are right now and answer one of the four. When it comes to investing, which of these four best describes you right now? Are you eager but unsure where to start? Are you cautious because you have been burned before? Third, are you steady? You're building but slowly, just adding to your investment. And lastly, you're confused because there's too much noise. We're in an era of too much information. I think in 5 minutes, the information that our brains have to process is so much. Could you be in that state? Mantui, what is coming up?
So we have a mixture. We have a steady, confused, cautious. I'm seeing a lot of steady. I'm building slowly, a lot of eager also, but unsure where to start. There's also confused. Yes. So it's a mixture mostly of eager and steady. Yeah.
Eager and steady. I like that. Thank you very much, Mantui. Ladies and gentlemen, the reality is at any given time, we find ourselves in those four states. There are times we could be eager, there are times we could be cautious, there are times we could be steady, and there are times we could be confused. But at any given time when we have extra coins in our pocket, we are always trying to figure out, what do I do with it? Do I just keep it and let it earn 2%? Or do I put it somewhere else and it gives me my 12% or my 15%? Truth be told, we have to invest if we have to grow. If we have to grow our wealth, we have to invest. So allow us to, today we'll use a lady and a gentleman, and for this first time, allow us to use Grace. Grace is a banker. She's a mother of two, and she had a major loan that had stretched her over the years. Now that she's finished paying that loan, she's feeling like she can breathe. She's saving, she's got a little bit extra. And now she's asking herself, how does she add to what she has? How does she protect her capital but make it grow? So she's had many stories about land, she's had stories about circles, she's had stories about money market funds and even crypto. Now, she does not want to lose and she does not want to make a mistake. Then she also understands that you cannot become a millionaire overnight, but she's looking for clarity and she wants her money to work for her. This is a situation most of us find ourselves in, that we are looking to make sure that we have peace, not pressure, and we can be able to grow. And some of the myths that we are normally told, that at times land doesn't lose value, land is consistent. For those of us who follow real estate, I think this week, Cash Consult, which does a very good job of just showing what is happening in the market, was able to give a report on areas where land value has appreciated, others where land value has gone down, areas where rent has gone up, areas where rent has gone down. So the market keeps shifting. So it's important for us to have those fundamentals as we go. So we are like Grace, because majority of the population right now in the country is at that age group where Grace is and Grace is playing at. So Grace is finding herself in a situation where she needs clarity. And she does not want to throw her money out. And she does not want to sit on her money and then years later regret. The good thing is, she does not need to guess. There is a formula that has been tried and tested over the years. You can learn how to evaluate your options. You can learn how to understand what is the difference between formal and informal investment. And the conversation starts this lesson and the next lesson next week on Thursday. And the most important thing is that you and I can continue building on investment plans that reflect our goals and our risk comfort. So this is where Grace is, and Grace is with us in this room today, and we will learn together with Grace. We also get to learn as we move along. So question to you and I today: what moment in Grace's journey felt familiar to you or is feeling familiar to you right now as we speak? And maybe let's utilize the chat space. What moment is feeling familiar to you in Grace's journey? Mantui, any answers coming in?
So not yet. I believe you guys are taking a bit, and maybe you can just go back to the scenario on Grace. We have Kitaka saying sitting on money. Shemin saying skeptical about where to invest. We have lack of clarity. Someone else says rushed into an investment I did not fully understand. Then seeking clarity among all the options. Loan that's finally breathing for being debt free. When you don't feel your money is safe where you invest. Martha says the whole process just concluded my loan end of 2023. I have been saving since then and I would want to know the best place to invest. We have Vedi saying currently stuck on loans repayment, looking for a reprieve, longing to finish it. Brenda says everything in general, her story mirrors my current situation. We have someone else saying the point where money is available, but nowhere to, like you don't know where to invest. Then we say stuck on loan repayments, looking for clarity. Yeah, so I'm seeing a bit of, lessons from debt management coming into play probably in today's session, because there's, being stuck in cycles of debt. And so making investments is still unfamiliar ground, but also people who do have the money and are not sure of where to invest.
All right. Thank you very much. Thank you very much for that, Mantui. So, ladies and gentlemen, as we said, we need clarity. Remember, we work so hard for this money. So it's important for us to be able to preserve it. So thank you, and grateful for wherever you are right now, because it gives us an opportunity to move forward, an opportunity, like you have all told me initially, to preserve what we have, even as we grow it. But as we preserve and grow, one of the things that we really need to have in place with us is clarity. How do we move forward at any given time? Now, thank you for your answers on the self-reflection exercise. And so where we come to is asking ourselves, what is investment and how then does it differ between savings and investment? Allow me to just take you very shortly between how savings and investments differ. Now, savings will give you security because your money will always be there. But your money will be there and it can be there and not grow. But then investments give you the freedom to be able to even move forward and to add to the savings that you are having. Now, savings are always safe. They will slip. You will go, you come back, you'll find them. Investments are risky, but they work. But remember, everything in life is a risk. You woke up today, got out of your house, took a vehicle or drove on the road, that's a risk. Today morning, as I was preparing for this lesson and I left to go get ready, I found this bus that had come from Western Kenya. And you can imagine when these people left, they traveled all the way to the road, but they knew they needed to get to Nairobi. You can imagine when they get to the entrance of the expressway, the driver lost the brakes. Thank God no one died, only the vehicle got hurt, but the vehicle went through the barrier that had been put there and was damaged. But it was a risk that they were taking when they knew I have to come in. And so that is the thing when we are talking about investments, talking about savings. We need clarity as we move forward. When we bought that vehicle, we know this driver is trained, this driver will take care of us. And so for this driver, when he lost control, what did he do? He knew I need to protect the people who are here. So what do? This barrier will help me stop the vehicle. And the barrier helped him stop the vehicle. So savings will preserve your money. Investment will grow it. Savings is a short-term horizon because you're looking at it now. Investment is long-term. Whether you're looking at a treasury bond, you're looking at land, you're looking at business. You're not doing this for the short term. You're looking at the long term. How will it work for me? Then saving is also low risk. I will go put my money, it's giving me 5%. Let me enjoy the 5%. Investment is high risk. It will give me my 12, my 15%, but there's a risk involved with it. How do I deal with it? Savings, you can put it in your bank savings account. You can put it in your SACCO savings account. You can put it in your Chama savings account. It will stay. For you to grow your investment, you will look at stocks, you look at real estate, you look at bonds, you look at things which will generate high-level income for you. Now, as you're doing your balance, for savings, you are looking at a security outcome that I have left this money there. When I come back in 1 year, I want to find my money there. And in life, we need to have a balance between your savings and your investment. So for investments, you're looking at growth and income. This is where I am right now. But I would like to be further in 5 years, in 10 years, in 15 years, in 20 years. Because truth be told, at some point we will have to, I wouldn't call it retire, but our life will shift. So investment helps us at that particular time when we are coming to shift. And we will see that in the fourth lesson and the fifth lesson as we plan for our later years in life. What are the things we need to look at? What are the things we need to do to make sure that we are still generating a revenue? So at Zurich, what we believe is investment is how you allocate money into assets. Which assets do you want to grow? Is it your business? Is it your property? Or is it your financial instrument? But remember, as you are allocating these assets, we are allocating them based on the potential to grow in value or generate income over time. So any investment that you're doing as an individual, you and I, we need to look at, is this going to grow in value or is it going to generate income for me over time? When we were talking about earlier on rushing into investments, I wouldn't ask how many of us have run to go buy quail, to do quail business, and we were told quail eggs are selling at 200 bob. How many of us rushed there then and did the quail business? How many of us have rushed because there is a parcel of land we were told this particular area, I can tell you, I can promise you, in 3 years, it will have grown. Hey, talk on you because the land guys took you there. And in the 3 years when you go, the roads that had been marked that time you bought that parcel of land have actually disappeared. You can't even find your beacon. Maybe you took 500,000 from your SACCO, knowing that I was told this land in 3 years will be at ₦1 million shillings. So you know you will be able to pay back your land and it will have grown in value. It happened. This is reality. Or we are told, invest in this. Let's do this business. Let's buy clothes from Turkey. And we can assure you for a fact, you bring these suits because these are the kind of shirts Joe and company wear right now. They'll buy them. Hey, shock on you. A month later, your stock has only moved easily or not moved at all. So for us, investment should be, how do you manage the resources that you have so that they can grow in value or generate income? And mark this word, manage. You allocate, then you manage. So for saving, you will be storing your seeds. And there can always be a balance that you take a bit from your savings and invest it. And when you invest, remember when you generate the revenue, then you could always bring back more into your savings and balance. There has to be a balance. Savings come in handy on a rainy day, and we will see that again in the subsequent classes as we look at how do we make sure that we can keep on running. So from us at Zurich, this is what we look at. So We won't go into a breakout room. And you already gave me some of these answers. But playing back at the people you see and where you are right now, where do you feel like you need most support in terms of making investment decisions? Could it be in terms of a mentor? Could it be in terms of a tracker? Could it be in terms of attending lessons like this? Or even getting a financial coach? Or even going to DTB and telling DTB, hey, DTB, you guys have been keeping money in my savings account. Please advise me on how else I could grow my savings. Where do you feel like you need the most help right now as an individual? And we thank DTB for this lesson, that series that they've put together. Mantui, any answers on chat?
Yes, we see mentoring, mentor and tracker. Irene says all the above. We see, as for me, I need a mentor. Marilyn says how to grow my savings. Florence says financial coach and mentor. We have a lot of all the above. Mentor comes also leading. And then Florence says how and where to invest. Someone says I would like to come out of debt, then establish multiple income streams. How to distribute the savings differently. Need an honest advisor, as many don't talk about hidden expenses and risk. And then how to deal with information overload. Mentorship, how to take risks. Yes, so we have a lot of mentorship and where to invest and all the above.
Okay, thank you so much, Mantui. For those of us who are discussing debt and you are not able to attend last week's class, please indicate on chat so that we can pick it up and see how the information can get to you on the debt management class. I saw there was a question on crypto. Please keep it locked. Make sure you attend the class next week. We shall be discussing a bit of that as we talk about alternative investments. And I don't know if you saw, the government central bank actually has put together regulations on crypto and how we can get to use it, because technology has changed how we deal. Technology has changed where the world is going, and we have to adapt to it. Now, ladies and gentlemen, truth be told is that at any given time, all of us need a helping hand to be able to grow. And the first place for us to grow is for you to access the information you need to understand where you are at, and then leverage on this information to be able to grow. So step one is in you attending this webinar. Thank you very much. We appreciate you for that. Step two is in the information that you get. One of the things you like doing is for you to self-reflect after the webinar. Pick what you feel will work for you. And then thirdly, now get in touch either with your RM or with your RM is retail manager, or your personal banker or your advisor, if you're a member of DTB, and talk to them about what it is you're looking at and where you would like to grow. Investment options are there in plenty, and the bank is here to help you grow your wealth even as you continue. And then log into our Zurich dashboard, Zurich Prosperity Dashboard tool, where you'll be able to get a mentor and you'll be able to talk and you'll be able to grow. So keep it locked even as we continue to grow. So as I have said, step one, ladies and gentlemen, is in us understanding why it's important for us to invest. And how then do we get to invest? Investment takes advantage of compounded interest. And compounded interest means that we have to be able to do this over a period of time and consistently manage, consistently invest for us to see a growth in our return. There are things that could make you overnight millionaires. For example, going to Vihiga or going to Migori and looking for a parcel of land and deciding, I'm going to be a gold speculator. Well, it could work two ways. Could either return your money very fast, or it could also take time before your money comes in. Yes, and we have gold in the country and there are people who are living off it. It's a high-risk business. It's also investment in a business. But now we are also looking at, because we are talking about capital preservation, How then do we continue doing this? Remember, a shilling today is worth more than a shilling tomorrow because of its potential to earn. And for it to earn, we look at the cycle of compounded growth. One is for you to invest money. And investing money means looking at your budget, looking at where you are, and seeing what you can allocate to an investment that will grow. Then secondly, is to make sure that that money where you're earning is earning interest, where you're investing is earning interest. Albert Einstein famously said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. If you look at how the financial institutions make money, they make money by compounding it. You earn, it comes. You take a bit, you reinvest the interest. As you reinvest the interest, remember your capital is still intact. Add what you've added, it keeps on multiplying. Now, last week when Brian was talking about an avalanche, you see it keeps rolling, keeps rolling, keeps rolling. So now with compounded interest, it's like building on a foundation. It grows, you come back, top it up, 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 and it grows. Eventually, you will realize that if you are not touching this money over a period of time, for example, if you are taking the money and every time it comes, you're investing in something that is working, within a period of either between 6 to 10 years, your money has doubled. Depending on where it is you have invested your money. It's science. Invest. 6 to 10 years, your money has doubled. So depending on what it is you are looking at, you could always put your money in an instrument or in a business or in land, but then also be very careful where you're doing it. And then compounded growth means that you have to keep on repeating this over a period of time. Don't get tired. There are times the markets will be good, there are times the markets will be low, but be consistent in your investment. No two times look the same, but then remember, a shilling today is worth much more tomorrow if you have invested it and left it somewhere. Why do we run now to put money in MMF? It's because we want more. It's because we want growth. Those parcels of land that we've talked about is because we want more. We want growth. But compounded growth is about consistency. So you have to be consistent in what you do. But then how then do we get to invest this money if we are being told we have to be careful, we have to do this, we have to be patient, we have to be consistent? Ladies and gentlemen, there is a formula to it. Now, remember everything we do is risk. There's risk involved, but the risk has return. So when we are doing this, we have to look at it in terms of what is this investment? What is this I am getting into? And what kind of returns am I looking at? If it's a business, get a professional to help you do the books. Get them to help you do projections. Then make sure those projections are realistic. Look at the people around you doing similar business, because remember, not most businesses are unique. How have they grown over time? What has happened? For those of us who've invested in treasury bonds, what have been the trends over the period of time? And then, is it possible that I might lose my money? Could be a possibility. So then how then do I get to make sure that I reduce my risk of loss to as much as possible? Then how easy is it for you to convert your investment into cash? Then remember we talked about management. Do you have control over the outcome? Or who has control over the outcome? Remember, some of these investments, we need professionals to help us do it. We need institutions to help us do it. You also need to ask yourself, what is their track record? What have they done before? How was it? What are the shareholders talking about? I'm not being biased, but if someone was to ask me today, Joe, I need to get asset finance, guess where I would send them? To DTB, very fast. Why? They've got strong muscle in asset finance, and they will show you how this asset can grow from 1 to 2 to 3 to 4 to 5. Proven track record. So as an individual, even as you're getting into an investment, ask yourself these 4 questions. What is my expected return? What is the risk of losing this money? How easy is it for me to liquidate the investment? And who has control over the outcome? Remember, your job as an investor is not to avoid the risk, but for you to understand it. Now, at Zurich, we recommend allocating your investment in a balanced portfolio. Have low risk investment, have medium risk investment, and have high risk investment. Now, the low risk investments will provide you with security and stability over a long period of time. They are there. And they are safe instruments which you can do. Then we have medium risk investments, which offer moderate risk, but then they also help you grow. And then we have the high risk investments. You could grow with high returns, but then your appetite should also be big. So understand yourself, understand the investment that you're getting into, then try and figure out, where do I need to play? So where we sit at Zurich, we know there is no return without a level of risk. But then the biggest risk is not investing at all and asking yourself, should I have done this? For example, this year, the stock exchange has done very well. If there was an investor who understood stock exchange and did not invest, right now, believe you me, they are pulling their ears. They are pulling their ears because over the period of time between January up to last week Friday, it has generated some good return. So it's important for you to understand where your money is going and understand how you will get it back. And understand you cannot grow without a risk. And like I said, when we are investing in our own, like in our own personal development, we go to the gym, we pay for the gym. We know that we could either gain muscles or fail to gain muscles. That when we are investing in our personal development, we could either grow right now or not grow at all, or grow in a period of time. All those are risks. Remember, you are deploying capital to do something. You're deploying capital for your health. You're deploying capital for your own personal development. So where do you place yourself? So it's important for you to do that. I take a pause to see if there are any questions that we need to respond to before we proceed.
Yeah, we have a few questions on the chat. And even just before I read the questions, we as DTB, we do not have like investments, for example, MMF, but what we do have is our custodial business unit. And if you are here in phase 1, I think we had our head of custodial business, Mahmoud, who came to talk about investments and some of the products that we do have. And what we can do is to share our contacts on the chat. When you reach out, you can get more information on custodial business unit, and they support in facilitation of different types of investments, and they also advise on how to go about this. So now I can read. We have 3 questions. Lorraine asks if you can expound on crypto and its benefits and how to go about it. We keep hearing crypto, but unsure about it. So let me just combine the questions. Then Andrew asks, if one investment is compounding, can it be leveraged to create other investments? And then Vedis has a dilemma. I took a loan to do business with a friend. I added capital on a business he was already doing, but I didn't get returns as I'd anticipated. I ended up pulling out with what I could salvage. I lost my money, used what remained to pay school fees. What did I do wrong? Yes, and then the last one. May I know the difference between MMF and shares? Which one is more profitable?
All right. Thank you, Mantui. Could you kindly go back to question 3 of who was it, Lorraine? No, who talked about the business?
Vedis.
Vedis.
Yes. So they took a loan to do business with a friend. Added capital on a business he was already doing, but he didn't get returns as they anticipated and ended up pulling out with what they could salvage. They lost money and they used whatever remained to pay school fees. And so the question is, what did they do wrong?
Okay, thank you very much. Allow me to take question 1 and 4. So crypto is tech-based. It's tech-based investment. It's currency that you cannot see and done using blockchain technology. Liz will be delving deeper into that next week on Thursday. So please make sure you come in. There is a way you can also invest in crypto. Follows the same rules and standards. It's all tech-based. I don't know if you've seen I don't know if there are any banks in Kenya at the moment doing it, but I know like banks in the US have really invested in crypto. So it's currency, but it's digital currency, and you can invest in it. Crypto also needs you to have high tolerance for risk, because one negative move, like the other time when Trump announced some trade barriers and the value crashed, and then it stabilizes, then the value goes up. So it's a good form of investment, but it also needs you to have high risk appetite. Then on MMF and shares, again, we'll tackle it next week on Thursday. But money market fund is you bring your money, different investors bring their money, pulled together, there's a fund manager. The fund manager invests the money in different portfolios, could even also be in shares. So you see in shares, you will buy the shares directly yourself, wait to trade, or you could buy through the custodial services and wait to invest. But with money market fund, they take it, then they balance this portfolio. They balance it in low risk investments, medium risk investments, high risk investments on your behalf. So if they promise you 12 or 15 or 14%, at the end of the period when they are paying you the interest, they'll be able to tell you this is where we invested the money and this is where we are at. For example, at the beginning of the year, I think money market funds had hit as high as 18% because where the fund managers had invested money, the returns were very high. But we've seen the returns come down, I think to yesterday, if I'm not wrong, the money market funds, the interest rates were between 12%, 10% annualized. Now, the good thing about a money market fund is that depending on where you or who you've invested your money through, they might allow you to withdraw. I know there are those who only allow you to withdraw once a month, some twice a month, some just 24-hour notice. And like for Safaricom on their ZD platform, you can withdraw whenever you want your money. So for shares, you take your money and hope and speculate, hope they will go up 2 months, 3 months, 4 months. It's a game of patience. But money market fund then is balanced. They invest in very many other things. So let's keep it locked. Next week on Thursday, we'll be delving deeper into that as we talk about alternative investments. Now, you can also leverage on your compounded interest. But as you're leveraging on your compounded interest or the facility you have, maybe you have put your money in a bond or you put your money in something that is generating returns, make sure that where you're going to invest is generating a higher return than what you're currently getting from where you have put your money. Remember, we talked about capital preservation. So as you are leveraging, ask yourself, if this is giving me 15% and I am taking it and I am pledging it somewhere to be able to grow further, where I'm pledging it, what kind of return is it giving me? Very important for you to consider that. Capital preservation, so that you don't lose what you already have and what you've already been generating, and then it all goes away. So leverage, yes, is good. Get a professional to sit with you and look at where is it you're going, and will it bring your money back or will it eat your money and make it disappear? I hope that answers that. Then when we're talking about business and when you're going to invest in a business, again, leverage on a professional, especially if you're going into a business that has already been existing. Does the business have plans? Does the business have book of accounts? And books of accounts could also be management accounts. Who has been helping them do the finance record keeping? Then get your own professional to look at those records and see and identify patterns. Do they marry? Do they tally with what has been said? What are the projections? And this business that you're going into, where is it placed in the market? What are the things surrounding how that business is existing? Does it have enough customers? What are the government regulations about that business? What is the future of that business? And it's sad that you did not get the money that you needed and you had borrowed to put your money in. Again, when you're borrowing to also put money in a business, will it generate enough return to pay off the loan or the facility that you have taken? So it's very important that whatever investment we are getting into, and I think we will look at that after the break, is that it's calculated. Understand where you are at. Understand first where you are at. Then understand where that investment is at and where that investment is projecting to go. Then how does your capital fit into where it is right now, where it wants to go, and your financial goals? They must marry. If there's a challenge or the returns don't make sense, don't borrow to invest. Because the investment should be able to pay back what it is you're doing. But most importantly, understand the business from the word go. I am coming into it. So what have you been doing? What was your plan? Where do you want to go? Do you have a model? Do you have a revenue model? Ask those questions of anyone who is telling you, I would like you to invest in my business. Thank you. Mantui, any other questions?
We have quite a bit, so I don't know if we
Wow.
should just maybe respond now at the end so that we're able at least to cover the content. And then, but I also see Elizabeth is helping with responding to some of them that are on the
Good.
Q&A tab. Yes.
Okay, so I think we can take the rest after at the end of it all. Thank you, Elizabeth, and thank you, Joel, for helping respond to the questions. So keep your eye on the space also as you ask questions. Joel, Elizabeth, and the Zurich team will be helping to respond to some of them. So, ladies and gentlemen, before we take a break, I think this is what I was talking about. Where are you placed? And where is it you would like to go? So your investment profile is a reflection of your reality, your mindset, and your goals. Your reality and your goals are very important. Where are you? Where do you want to go? And then your mindset. And you will realize that when we're investing, there are so many things that influence where it is you would like to invest. One could be time. I'm like, I need to invest now because I need my money back in 5 years. That's a time, that is mindset based on time. Could be, we've always been told, don't buy shares, your money will disappear, the company will go down. There are cultural and social things that go through us. There are those who are told, do not build a house because you will die and you leave it. Don't invest in real estate. Someone else will steal your money. Mindset. Also, another mindset issue, being told at this age, you should invest in A, B, C, D. So we could find all these things blocking us and things telling us, don't run here, don't do this. Now, all these are things you need to look at. Where are you? How is your income? How is your cash flow stability? Where is it right now? And your income, how does it match to your financial goals? So it's important for you to understand all these things and balance them out. Your personality and your emotional tolerance. How would you be when you lose money? Will it crush you? Or will you go look for help and come back and say, I'm running again? And remember, yesterday's win is not today's win, is not tomorrow's win. So all these things come into play. So we need to ask ourselves, what is my tolerance level? And the reason why I'm doing all this is so that, one, this is where my income is. I would like it to grow. Those are your financial goals. And the reason I want it to grow is because I want to build my net worth. And your net worth means increasing the savings and assets that you have and having an emergency fund that in the event of something, can I be able to pull out money from my MMF? Or can I be able to liquidate the asset that I have and I be able to grow? So all these things play a part in making sure that you can grow, you and I can grow as investors in our own simple ways. We are all investors. That's the reason we wake up every day. Either invest in your career, invest in your business. And as you're investing all this, it brings us returns. What do we do with these returns? We look for places to put our money, a piece of land, a savings account, a treasury bill, a company corporate bond like the one that East Africa Breweries has just floated in the market with a return of 11.8%. So all these things play a dynamic into where it is you would like to go. And it's questions that you need to keep on asking yourself. Do I have the right mindset to grow? Or what is stopping me from investment? And if it is my cultural, social, and community influence, who can help me overcome this? Get a professional. Sit with them. Share your fears. Let them sit with you and help you overcome those fears. Help you go through personal exercises to help you overcome those fears. And that is why I was talking about the Zurich dashboard. Because in there, we have coaches who sit with you, coaches who talk to you, coaches who understand because you have logged in, you have planned yourself, this is how I want to grow, and then they help you overcome those biases, help you overcome the challenges that you've had, help you overcome your debt management. So for all of us, I know Liz will talk about the Zurich dashboard. Log in, help you run. That as you put your money in DTB, as you're generating your money and putting it in your savings account, we are also helping you monitoring to grow. As you open that business account with DTB, where are you taking your money? We help you, we keep on helping you grow. So it's important to have an accountability partner when you're investing. So like I've said, we have to cross some of the beliefs that we have. At the moment, looking at where it is, in your 20s and 30s, it's the best time to start investing. But in your 40s and 50s, it's still also the best time to start investing. So the best time to start investing is this minute. But remember, as you invest, you have to make sure that you're taking care of your capital and you're preserving it so that it can be able to grow. So invest with clarity. So between your 20s and 30s, build a habit right now and start compounding. If you're between your 30s and 50s, grow what you have and diversify your wealth. Work with a professional. Attend classes like this. Get to learn, read, research. This will help you reduce pressure as you grow. If you're in your 50s plus, preserve what you have. Very important, because we said age truly catches up. But as you preserve this capital, work again with professionals to figure out, how will I generate income from the capital that I have, and how do I secure then the legacy that I have been building? That in my 60s and 70s, I'm still having something coming. So again, looking at it through ages. If you're in your 20s and 30s, ladies and gentlemen, maximize on long-term growth. Sacrifice. I can tell you for a fact, when you're in your 50s and your 60s, you will be smiling. In between your career, balance your risk and diversification. This is the time where a lot is happening. You're building, you're doing school fees, you're doing your master's, or you're doing your degree, or you're investing in other things. You're also supporting family. So it's important to have a balanced risk. And the diversification helps, because the diversification then ensures you've got an extra coin to help you take care of these things that are coming in. And when you're in your 50s plus, it's important then that your investment focus is on stability and income generation. So if you can see at all these levels, you can start your investment. In your 20s and 30s, you can risk more because the returns will be higher. In between your 30s and 50s, have a balanced risk. As you've said, there are so many things that you're juggling. Make sure that as you're juggling all this, what is the one thing you've all told me? We would like to preserve our capital. We would like to preserve our capital. So preserve that capital. And in your 50s and plus, this capital that you've preserved between your 30s and 50s, hold it. Don't do risky investments. There are still investments that can generate revenue for you. So in all classes, there is the ideal, but in all classes, there are different places where you can invest your money. And what we advocate for as Zurich is be consistent in your investment. Diversify your investment. Use tools and then have a plan. And most importantly, make sure that whatever it is you're investing in, you can be able to liquidate in the event of a challenge. So as we prepare to go on a break, what stage are you in your life currently? Are you early career, mid-career, or preparing for retirement? And what is your biggest financial goal in the next 3 to 5 years? So how are your current savings and investments aligned to that goal? So I'd like you to ask yourself those 3 questions. Where are you? What are your goals for the next 3 to 5 years? And your current investments, how are they aligned to making sure that you can retire or rest or be easy? And as I invite Mantui back, allow me to give you a personal story. So I turned 50 in exactly 2 months. 2 months? Yes, in exactly 2 months, I turned 50. And at the beginning of the year, the places that I have invested in, especially for a pension plan, they both reached out to me. And age always comes, ladies and gentlemen. And yes, I am still young. I still have some hair. Don't let the baldness distort you. This is just a style. It's a brand style. So they both reached out and asked me, how do we help you plan for the next 10 years after your birthday? You turn 50. This is what you have saved so far. Where would you like to Where would you like us to put this money? So that's the question I ask you even as we prepare to go on break. Where would you like to be in the next 3 to 5 years? Mantui, over to you.
Thank you, Joe, and for posing us on a reflective note. So we'll take a 10-minute break and we'll be back at 12:10 as you ponder on that question from Joe. Thank you. All right, welcome back, ladies and gentlemen. We were on a short break, and we shall continue. Karibu sana, Joe.
Thank you very much, Thank you very much, Mantui. As we were taking a break, the question I asked was, what life stage are you in, and what are your goals for the next 3 to 5 years? Maybe Mantui, you could read for us 1 or 3, and then 1 to 3, and then we can proceed.
Okay, so we have quite a number. So we have Ida saying mid-career, have several investments in different areas, planning on taking a more active role. Colin says preparing for retirement, still have 15 years or less. Biggest goal in 3 years is passive income. Hapo kwa savings kidogo issue. And then I want to read one on retirement because we had quite a number. This is a fun, as shared a bit of a funny one. But let me read Lawrence. She's saying, going to 50, we are currently educating in university and secondary. Investments are there, but for education of kids, next 3 to 5 years, we would have like to be financially free if possible, having catered to our current and second child's university education and have good investments to cater for our retirement. So we have a mix, a lot of mid-career and planning for investments, quite a number also of those who are about to retire, and a few early career.
Thank you very much, Mantui. Thank you for that. So I'm not alone in my tribe. Phew, at least that is good. So thank you for that. Ladies and gentlemen, at any given time, we are at a certain stage in life that we need to go. We need to grow to the next one. So how do we protect what we have, and how do we go? So welcome to our introduction. We began this conversation, but let us begin this conversation even as we go towards next week. Formal versus formal investments, and in terms of fixed investment income as the first option for you as an investor, even as you move towards alternative investments. Now, as we've said, we are always navigating. What should we do? Remember, not all investments are equal. Some are structured and regulated. Some are structured but not regulated. Some are based on trust. For example, was it Vedishi who said she was told by a friend, come invest this money and then it will come. We will bring it back. You see, in her case, it was an informal investment, but it was relationship driven because it was based on trust. And then some are structured and regulated. For example, MMF. You must get a return, and they cannot touch. Your fund manager cannot touch your money. Your money has to come back to you. Maybe it will not come back with the 15%, but you will get back your money. So there are those that are structured and regulated. For example, even treasury bonds. We know your money will come back to you. That's why when the government says we oversubscribe, we run, we put all our money there. So it's important for you to make informed investment decisions. Where I'm putting my money, how is the whole thing structured, and what kind of safeguards are in place? So just a quick run through on formal and informal investment. In terms of regulation, formal investments are regulated. Someone is watching what is happening to your money. Informal investment, there is no regulation or it's self-regulated. In terms of legal protection, there are laws governing how your formal investment will have to work out, and you have contracts, and you have, in the event that you lose your money, there is a redress system. In the informal investment, it depends. There could be a contract, there could be no contract, could be also a social contract. And those who've invested your money then based on the community know that if this happens, I will pay or my family will pay back. For you to access the money in terms of a formal investment, there has to be a minimum in terms of how much you want, what kind of documentation you may need to provide. For informal investment, you could access your money whenever it is you want. Transparency, any formal investment must have audit, disclosures, reports in terms of what is happening. For informal investment, could depend on where you have invested. If a friend told you to give money, if their culture is not in giving reports, you would be in trouble. Risk levels, formal investments, lower because there's structure on it. But for some formal investments, risk levels could also be higher, but then there's structure. Informal investments, the risk level higher. Because you see, it depends again on culture. So remember, in all the things that you do, trust is good, but structure is better. Make sure there is structure in where it is you're investing your money, even if it's a friend's business, so that you can preserve your capital. So there has to be clarity. Formal investments are governed by legal systems and data that informs the decisions that you're making, the decisions that you will make. In the informal investment, could be because I am investing because I know Mantui. I'm investing because I know Liz. I'm investing because I know Lorraine. But in all these things, let there be structure. Even if you're going to put your money in an informal investment, they are not used to legal systems. Try and get some paperwork. Try and get some documentation in place. It will cover you and it will help you as you grow and then you move forward. So now that you understand what you're doing and where you want to put your money, there could be two ways for you to invest. You could either decide I am doing this directly and you personally manage your investment, could be a business, or could be buying even the bonds using at the central bank, using the DAO app. You personally manage how you're moving your money, or could be indirect and you delegate to a manager, a fund manager, who will help you then balance your investment and manage your risk. Now, all these things again require a balance. What is it you're trying to achieve as an individual? So it goes back to you understanding your financial goals, you understanding where you want to be, and what you can afford to risk, what you can afford to lose, as we will see. Question we are always asked, how should I invest my money? Now, if you would like to have direct control and active involvement, make sure number one, you have the time. Number two, you have the skill. If you don't have the skill, build the skill. Find out, learn, network, get professionals to help you. If you do not have time, get a fund manager to help you invest your money. Now, fund manager sees much more than you see because from where they sit, remember we said they have the benefit of data to help them see what is going on. So as you invest your money, get that extra 1 shilling, 2 shilling, and get a professional who you can afford to pay and a professional who will not be biased, and a professional who will help you move and help you open your eyes to see this is where I'm going to go. Remember, what we are looking at is as you preserve your capital and you grow, you have a peace of mind knowing that this is where my money has gone, this is where my money is, and this is how my money is going to come back. Very important for you to look at it that way. That if I have the time, I will build, I will learn, I will invest, I will ask questions, I will build my muscles. If I don't have time and I still want to invest, go get the professional. Like Mantui has told us, you're a customer of Diamond Trust Bank, walk in, go and talk to their custodial services business and let them be able to give you a good view of where the market is, a good view of what it is you should be doing. In short, ladies and gentlemen, you need an accountability partner and you need extra eyes other than yours if your investment is to grow and send you further. And help is only a phone call away, an email away, a walk away, a question away to you being able to grow. So then you ask me, so Joe, this is what you're telling me to do. I would like to invest indirectly or I would like to invest directly. What then should I need? What then should I ask? What then should I do? What then should I be looking out for? Looking out is important. I can tell you I was asked a question in January, I have not responded. And when I was talking to Elizabeth the other day, she told me, hey, you know, you need to give a response to these guys before your birthday. Otherwise, your money will stay where it is. What is it you want to do? So there is the basic due diligence to the most comprehensive due diligence. And at Zurich, we highly recommend do not invest in anything you do not understand. Because remember, once you invest, the money has left your hand. So with due diligence, it helps you know, okay, I've removed my wallet, this is where my money has gone. And it starts from the most basic to the comprehensive. And the most important thing, if you look at the middle block there, it talks about exit. How will I get my money back? And how will I be able to exit this investment I have done? So that is the most important thing when you're doing your due diligence. Can I access and can I exit, even as I give out my money? So some of the basic things that you could do is understand, how do these guys make them, how do this invest, where I'm putting my money, how do they make their money? And these returns that they're generating, are they realistic? Where is the market at right now? Are they asking me, telling me they'll give me 25% returns on my savings? Yet when we come back and we look at where the market is, the average market rate is playing between 12 to 15%. So what is this? This investment is putting its money in that is bringing back these high returns. And then what are the risks involved if I put my money here? Are there things I'm not seeing that I need to see? And in the event that I've given my money, remember, we have said once the money has gone out from your pocket, it has already gone into the investment. How do you protect and preserve this capital that you all told me about? I need to preserve what I have. Clarity becomes very important. Due diligence helps you get that clarity. So those are the basic things. If we could go further, could be asking, is this investment regulated by anyone? What has been the history over the last 2-3 years in terms of, are they paying back investors? They've told me they'll charge me, I will get 25% interest. Is there a fee involved? You could be charged a high return on the money you're putting across, and then also come to realize there is a small fee that maybe no one told you about, then that small fee impacts on the net return you're supposed to be getting. Remember, I could have told you I'm giving you 25%. And the question we had been asked, can I leverage on my investment? Now, as Joe, I know I'm going to make 25%, right? So I'm certain that even if I borrow at 18%, I'll make 25%. So I am covered, I have a 7%. Only for you to come and realize when you're being paid back, oh, they were taking 5% as fees. So you are left with only 2%. 2%, remember, you are trying to compound. Does it make sense? Food for thought. So ask all those difficult questions you need to ask. That this is what I am making. What are the fees associated with this investment? And other than the fees associated with this investment, how is me as Joe investing in this tool or in this business aligning to my goals, my 3-year, my 5-year goals? And because I know this is where I am at, how much am I ready to lose, or am I willing to lose? Or how much should I not even lose at all? Those are very important questions for you to ask. So due diligence, very, very important. What are you investing in? What are the promised returns? What are the regulations around this? What are the risks that go with this? What are the charges? Can I access? Can I exit? And how do they align to my overall goals? Also, don't invest in something that you will have sleepless nights. And every morning that when you're waking up, you're waking up to go check in the bank. Is my money there? Investment should give you a peace of mind. So remember, due diligence is how you and I will protect our capital before it leaves our hands. So, as we summarize on that, how much money am I making? And are they explaining it to me in a very simple way? I don't want to lose, but in the event that I will lose, how much can I afford to lose? Then go back to history. I know we don't live in the past, but there's a lot of knowledge picked up from history. What are the success stories based on investment? What happened? What did I do? What did they do? How did they make their money? How did they secure their return? Before you invest, investigate. And as Warren Buffett says, do not invest in a business you cannot understand. If you don't understand, please take the money, let it stay in the savings account. As you gain some knowledge, as you gain some skills, as you gain the professional help that you need to help you be able to move forward. So once you understand all these things, it's simple enough. This is how the money is being made, and this is how I'll get my returns, is the sweet spot. Invest. If you're not so sure, take a step back. Ask questions of yourself, of the investment. If it is not very clear, get yourself a professional for you to be able to grow. I know there's also AI that can help you answer, but sometimes AI doesn't have that human touch. There are professionals who are here to be able to walk to you, and they'll tell you, and whatever you learn from AI, they can help you break it down into a more realistic with a human touch for you to see how best you can make your money. So I think we'll give you this as your homework. And we'll pick from here next week. even as we go into fixed investment. Look at where you are right now. And this will come with the slides. And answer these 10 questions. What did you invest in? Who was managing the investment for you? What return did you expect? And what did you get back? Or what are you currently getting back? And where you have invested in, is it easy for you to exit this investment? And I know we'll get the slides, but allow me to just do something. I'll put off my video so you don't take my photo. Thank you, Victor, for co-facilitating with me. Let me just do this. I'd like you to take a photo of this screen. Then we can move on. Take a photo of that particular slide. And as you sit to take tea today, ask yourself these questions. Let's have this conversation next week when we are back in this room. And the most important question, would you do it again? Or what would you do differently? Based on the knowledge that you've been picking from this series, and based on some of the conversations we've had today and from each other. I hope you've taken a photo so that I don't appear on your phone screen as a screensaver or as an emoji or as a meme, and then we can proceed. So ladies and gentlemen, as we get close to landing the plane, allow me to introduce you to Joel. So Joel is a marketing executive. He earns between 70,000 to 80,000 shillings at a Nairobi-based fast-moving consumer good company. He wants to invest 100,000 for growth and safety over the next 3 years. But he doesn't want to lose money. He wants better returns than savings. But he also wants to make sure that, because this is the age we talked about, that in the event of an emergency, he would like to have access to cash, and he would also need to have clear documentation in terms of where he's invested in. Where would you advise Joel to invest this cash? Maybe monthly we can have 1 or 2 answers from chat.
MMF, this is by Eva. So Martha says, I like number 6 and it got me. Okay, yeah, so sorry, they're coming in fast, but a lot of it is MMF. MMF, yes.
A lot of this is MMF.
Yes.
So thank you very much. So ladies and gentlemen, remember we are building on the knowledge that you already have. So we consider, based on where he is right now, 70% in money market funds, because he needs to be able to be liquid. And then because he wants to save and be able to grow, 30% he should put in a SACCO. SACCO gives us discipline. SACCO helps us attain our financial goals. And if possible, as I gave that story, please do not go to land groups that are not structured with contracts and timelines. Don't invest your money and then 1 year down the line when you go to where you had been told, this is the promised land, it's flowing with milk and honey, and then on you go when you go and get there are shrubs and bushes, there is no path, you don't even know where your land is, no one can even help you. And you go back to the office, they're like, hey, yes, we gave you your title. Here is a copy, and you have a title and you do not even know where your investment is. So very, very important. Understand where your money is going and have control over it. And as we said at different times, sit with a professional, let them work out for you a structure. This is how we look at it, and this is where we go. Remember, your peace of mind is worth more than promised profits. capital preservation is very important. So make sure then that you know where your money is going to and where your money is and how you can be able to access it. And thank you for being good teachers this morning and even advising Joel where he should put his money. So as we land this plane, we now come and talk about fixed income securities. And fixed income securities is where we know how much money we are going to make, when we are going to get our return, and when we are going to get our capital. So three very key things about fixed income is that the return is known. By the time you're coming to start, the return is known. Secondly, your capital is protected from whichever market fluctuations, whether the market goes up, down, inflation does its magic, you had been promised a return, and that is how it comes. If it was 12%, it comes as 12%. Then the risk is lower because remember, if the return is already known, your money cannot play ping pong games, it will stay and it will come. You are promised 12%, you'll get your 12% less the withholding tax that has gone to the government. You take your net interest, you walk away. That is what fixed income does for us. Now, a few things about it. One, because the income is predictable, you will get regular interest payments. Because it has got low risk, at maturity, you get your capital back. The volatility levels are also low. It's been promised, it will have to come whichever way. It allows you to diversify. You can buy as many fixed income depending on when it is they are being done, whether it's with the bank, whether it is with the government, and it stays. Sometimes we get tax-free bonds if you invest in like the infrastructure bonds. And then when the economy is not performing well, everyone runs to fixed income and sits and they're like, let everyone else struggle to make money. Let me enjoy. Let them make money on my behalf. And they'll come for your money. The good thing about fixed income is that it also saves you, as I said, when inflation plays up and down, this is what was agreed, this is what it will come to. Now, when you're coming to invest in a fixed income, there are many factors for you to consider. And I know Mantui will share this slide. So look at this when you're taking tea later on and ask yourself, if I was to invest, where will I invest in my fixed income? So a few ones that I will point out. Number one, does it align with your financial goals? Why are you investing? So your purpose of investment should be very clear. Secondly, your liquidity risk. Am I able to get my money back in the event that I need it? How easy is it? Number three, tax considerations. Death and taxes are sure. So this is what I'm investing in. How much do I need to pay as taxes? Because that will come. Then looking at regulation, how well is it regulated? Who is this who is doing all this? Is it possible that they will default? So those are some of the key things you need to look at, in addition to all the others that you can see in the screen. Now, in short, whatever you're investing in must match your financial goals. Now, the next 3 years, the next 5 years. And the risk levels therein, ladies and gentlemen, should be managed well. We would like to preserve our capital. And the best way to preserve our capital is to have clarity on where it is we're putting the money. So whether it is in that treasury bill, whether it is in that treasury bond, whether it is in that corporate bond, whether it is in that fixed deposit account, whether it is in that call deposit account, we need to have clarity on our fixed income investment. That it is helping me manage my goals and moving me closer to my goals and helping me grow my net worth and my assets. When you get this slide, make sure you go to this slide and look at this in detail. It helps you have a 360 view of where it is you're putting your money. And this also helps you ask questions of when you're asked, invest in this. What kind of questions then would you need to look at and ask yourself, how is it working? So, because you are going to ask all these questions of someone who is telling you, come invest in a fixed income, there are a few things that normally come. For example, value date. That is the date when your interest starts accruing. They will tell you something like nominal or principal. That is the initial amount of money, your capital that you've put in. Maturity date, when that fixed income tool or investment is supposed to, it is ready for harvest, it comes back, and your investment comes back. Then the yield, which is what is the kind of return expected upon this. So those are very important terminologies for you to understand. When you're discussing whether it's with your professional or whether you have gone to the Dow CSD to purchase for yourself directly, look at those things and ask yourself, what does it mean? But this is what it means. So when will my investment mature? I have put in the money today. When does it start accruing interest? When do I expect my money back? And over the period of time, how much is it generating? And when should I be receiving my interest? Because fixed income investments give you periodic payments. Then what is the tax? For example, this is a bond that was issued this year. It's been reopened in the market. And you can see the government wanted to raise 30 billion from it. But they received bids of 54 billion. They didn't accept all the 54 billion. They accepted 43 billion. Out of which competitive bids were about 32 billion, non-competitive bids were 10 billion. So here's the catch. When you're coming to competitive and non-competitive bids, and you see this information put there for you, competitive bids are normally done by institutional investors. For example, your bank could buy on your behalf, or someone else, like an authorized party could buy on your behalf, and the government allows them to do a competitive bid. The non-competitive bid is normally for retail investors, and you have to start in multiples of like 50,000 upwards to I think maximum they'll allow you to invest is 50 million. And you can do this from the comfort of your home. But for non-competitive bids, you will take the interest that is there. For example, you could find competitive bids. I've got here the market weighted average rate was 13.7%. And the accepted bid, the government decided we are only going to pay 13.64. And you could find that maybe the competitive bids were like at 13.8%, and what the government was giving was 13.5%. But then the non-competitive bids also get to benefit. But there you don't have much say, but at least you'll get your interest. So here, the government was able to give a rate of 13.6. Then for this, I think because it's a 10-year bond, it's a 20-year bond, you get to pay withholding tax of 10%. Anything that is less than 10 years, then you get to pay a withholding tax of 15%. And that tax is normally final on the 15%. So remember, on the 13.6% you're making, there is a government tax of either 10%, 15%, or no tax at all, depending on what it is that the government has put forward to you. So it's important for you to understand where is your money going and what is happening. So for example, this was a very good investment. It's a government bond, so for sure, the government will not default. It's going to pay back. And there are different ways you can be able to invest in some of these facilities, either through an intermediary or directly using your DAO CSD, a CS bank app that allows you to invest from the comfort of your home. I know there are times they also do the infrastructure bond, which is the Emakiba. Emakiba, again, you do from your phone. You can be able to purchase and work with it. So very important is for you to understand, if I am investing in a fixed income security, what is that money going to do? And how will I get my money back? For example, if we go also with the one that the East Africa Breweries has put in the market, they would like to raise some money to do some expansion, retire some expensive debt, and they're telling you, in 5 years, you will get your money back, and every year we will be paying you 11.8% interest, some tax on it, but every 6 months, then you should be able to receive some periodic payment from us. But in 5 years, we shall retire and give you back your money and for you to walk away with it. I stop there for any questions and reflections. Back to you, Mantui.
Thank you so much, Joe. We have quite a number of questions. I'll also encourage those who've raised their hands. I can see Adiambo, so maybe I'll allow her to talk even as we now look at the rest of the questions. But thank you so much for that deep dive into the first section on investments. You can see some appreciation coming right there. Thank you everybody for that, for the appreciation. So Adiambo, you can go. So I think she has an issue with the chat, but let me proceed to read some of the questions. We have George saying, I have been saving in an education scheme with an insurance policy for about 7 years with around 250,000 saved so far, and I still have another 7 years till maturity. Do you think it is wise to wait until maturity, or would it be better to pull out and get this 250K in a special fund like Mansa X, which has been doing well and great returns, or even stocks? And just even on that is, we've gotten a question around if insurance is considered investment, and someone also touched on Mansa X and Oak Fund. So I think you can combine the two if it's something you'd recommend, and what are your views on the same?
Thank you very much. So Mansa X, I will park that question for Mansa X until next week when we are dealing with high-risk alternative investments. So Mansa X is a high-risk investment. The returns are good. I think it's averaged more than 25% this year. So my question would be, if you are putting away this money for a purpose, if you were to lose it, is there another way that you will be able to attain that goal? Remember, capital preservation is important. What are you willing to risk? What are you willing to gain? And what are you willing to lose? Now, when you're going to a special fund, don't just buy. Sit with professionals and let them guide you for you to get to know what happens. Remember, we said the market is very volatile for some of these investments. Market can go up, market can crash. Goes back to our mindset. Are you willing to lose? And in your willing to lose, will you still have some more capital that you can be able to invest? Other option would be, try it out and balance. Retain some money this side, invest in a special fund, even as you build your skill and get to understand this is how the market operates. So then that you don't remove all your money, put it in one pot. Diversification is important and you lose. So it's very important for you to understand, where are you at? What are your financial goals? What are you willing to gain? What are you willing to lose? Now, insurance is a safety net. I know they've got different investment programs down there, but insurance is more about capital preservation. Making sure that you still have access in the event that anything happens. Back to you, Mantui.
Thank you, Joe. So let me read Adhiambo's question. I've seen it in the Q&A tab. So my siblings and myself inherited some land and rental property. We are currently discussing investment options for the land and property. The returns on rentals are not viable for 8 of us. We are all in our late 40s, 50s, and 60s. We don't know what to do with the land. Is it worth keeping any of these investments given our ages?
All right, Adhiambo, thank you for that question. And thank you that you are all in one accord. And by one accord means you're not fighting, so that the capital that you're aiming to preserve is being torn apart. I think the most important question that then I would play back to you is, what is the current valuation of your assets when you put them together? That would be the starting point. What is the current valuation of all those assets put together? And then if it's calculated for you by a professional, what returns have each of those investments been bringing in? Then after that has been done, come back and look at what are your own individual financial goals as individuals. Then how best can these assets help you as a family generate the revenue that you need, income that you need, even as you grow the investment? There are some parcels of land which could be inherited and you cannot sell because it's ancestral. But there are some which parents had done an investment. Maybe you could turn it around into something. But that calls for be open and willing to call a professional on board to help you have a look, do an audit of your assets, do an audit of the returns, then help you even project forward as a family. Where would you like to go? And how would you like to grow? Now, based on that, professionals should be biased, not attached to any of you, so that whatever comes on board is clean, clear. See, could be that maybe whatever you have doesn't need to be sold off, just needs a better management or better investment to generate higher returns. Or could also be that it might make much more sense to offload now and invest in other facilities or investments that will give you higher returns than what you're currently doing. But it all begins with an audit. Must have an audit conducted. Thank you.
All right, thank you. I think we can wind up with two more questions. So the first one is, if I see an MMF return in the public it's high, like 12%, but my monthly statement is about 6%. What should I do? Are there hidden costs? I have others of which the rates in the public link with what I get. And then from Eunice, who says, can you please explain the difference in government bonds, T-bills, and T-bonds?
Okay, thank you very much. So we'll pick the first question. And then Mantui, I have a suggestion. I don't know if that would work. Would it be possible for us, the questions that we'll not be able to tackle now, maybe we could get them, and then as you send out the slides, we could also do an FAQ with us having answered some of those questions. Would that work?
Yeah, I think that can work. What we
Yeah.
can do maybe is, because the slides will go out automatically tomorrow,
Yeah.
maybe we can combine with next week's, because that's also on investments. And then towards the end, share now, the FAQs.
Fantastic. Thank you very much. That works well, so that we all get to learn and not lose anything. So for the question on an MMF, if it's showing a high return in public, and the statement you're getting is showing a low return, please walk into the offices and ask for clarification. Why the difference in information? And remember what we talked about. Could be that there are fees you're being charged and no one is telling you about, but your money is going. Ask those difficult questions. And do you know why you need to ask those difficult questions? The money is yours. Ladies and gentlemen, the capital belongs to you. The wallet is yours. You have removed the money and you've given it out. How does it come back? Because remember, it's coming back. You're not a charity. So ask of those hard questions. Ask of those hard questions. Do not be afraid to ask of those hard questions. And if the answers are not forthcoming, the money is yours. How easy is it for you to liquidate that investment, get your money back, then invest the money in something else? Very, very important. So consider that. Do not be afraid to ask questions. It's your money. Capital preservation. Clarity on your capital growth is very important. Two things that you have mentioned today: capital growth, capital preservation and clarity of where my money is going. So the difference between the treasury bills, treasury bonds, and corporate bonds is treasury bills are normally short-term investment instruments. So it could be 91 day, which is 3 months, 6 months, or 1 year. And this helps the government be able to raise money for its short-term obligations. So if you invest in a treasury bill, in 3 months, you expect your money back. Now, the returns are normally not as high as a bond because it's a very short-term investment. So you could either choose to put your money in a 3 month, in a 6 month, or with a 12-month facility, depending on what the government is putting out. Now, all these again depend on you as the investor. How fast, how soon do you need your money? If you don't need this money in 6 months, you can put it in a 6-month treasury bill, which will give you better returns than a 3-month treasury bill. If you need your money in 1 year, then put the money in that 1 year treasury bill. It will offer better returns than the 6 months and the 3 months. If you need your money very fast, put it in the 3-month treasury bill. In 91 days, you will get your capital back. Now, are they high risk? Yes, they are high risk. But you know what? It's also good because it's guaranteed by the government, and the government will always pay you. If you can see even with our government right now, one of the pressures that they have is to make sure that they do not default on any treasury bill or treasury bond. Reason being, it has an implication on your economic status as a country, on your financial status as a country. So government never want to default on that. Tax on the 3 months, 6 months, on the 12th month is 15% on the interest that you're being paid. It also starts with multiples of 50,000 shillings going forward. If you want to invest directly, go to the treasury, go to the central bank website, download the DAO CSD app. You can become an investor directly. The treasury bonds normally start from 2 years, 5 years, 10 years, 15, 12 years, 15 years, 17 years. They vary depending on why the government is raising money. Now, the interest rate on a treasury bond is normally higher, and the tax also varies. It depends. Tax could be either 15% if it's short term, 10% if it's long term, no tax if it is no tax if it is an infrastructure bond. So it depends. Medium term bond like the one East African Breweries did, there has to be a reason why they are raising money, regulated again by the Capital Markets Authority. Interest on that should be about 15% on the tax payable. So that is the difference. So bills short term, bonds are medium term to long term. Thank you.
Thank you.
Back
Thank you,
to you,
Joe.
Mantui.
Thank you so much. Ladies and gentlemen, we are right, at the end of our session. And I know there's so much more to discuss, but like Joe said, we can revisit these questions. As you have been told, we will continue with part 2 of this training next week, and it will be on equities, collective investment schemes, and real estate. So please tune in, call a friend, even your family members. A number of you have shared that you are in considering investments with family members. So it would be good if you all learn together. So thank you so much, Joe. Thank you, Elizabeth. Thank you, Roslyn and Victor, for sign language interpretation. And everybody, thank you so much for the engagement as always. So we resume next week, same time, same place. Last week we shared the recordings, but not the presentation. So look out for the same this week. So thank you, everybody, and have a good day.
Thank you very much, Mantui. Thank you much, everyone. And we are looking forward to seeing you next week.